Investors Chronicle.
Hello and welcome back to the IC Interviews podcast. I'm Dave Baxter. I'm the funds editor on the Investors Chronicle. And with me today is Chris Tennant, one of the managers on the Fidelity Emerging Markets Trust. Fidelity took over the management of the trust back in late 2021. As with many EM funds, we've seen some ups and downs, had quite a tough 2022, eked out some small share price total returns last year. But this year it has been up by a substantial amount. It's a very topical region, of course. There's been excitement over the Indian elections. There's still very much an uncertain backdrop for China and many other twists and turns to consider. So, Chris, thanks for joining. How are you doing today?
Yeah, very good. Thanks for having me.
So, I wanted to first of all discuss, I guess, some of the kind of stocks in the portfolio. A name that's very prominent in the trust and more generally in emerging markets now is Taiwan Semiconductor manufacturing. So at my last look at your literature, it was nearly 11% of the funds. And then recently, if you look at the kind of, the widely followed MSCI Emerging Markets Index, it's nearly 10% of that. So it almost feels like you're kind of approaching a situation similar to what, people bemoan in the US or so, where you have these kind of stocks that are a huge part of the market, and then active managers have quite a tricky decision of, how much it's a very big call even to go slightly underweight or slightly overweight. With TSMC, first of all, I mean, is there a kind of self-set limit on like how large you would run the position, and how are you kind of feeling about the prospects for it?
Yeah, so absolutely, yeah, it's becoming an increasing part of the benchmark, and I think given some of the sort of the positive trends that TSMC is seeing, that's only set to continue. So, and we are limited to keep the position around about 10% of the fund. So that is the maximum threshold we're allowed to have, and every time it sort of goes above 10%, we will cut the position back, which is something that we're having to do today. I think the future still looks fantastic for TSMC. When you look at some of the sort of the performances of other stocks that are linked to the theme of AI in the US, and Nvidia being the sort of the poster child for that, you've seen a huge amount of performance in some of these stocks. And whilst TSMC has done well, it hasn't kept up with the likes of Nvidia. And so Nvidia today would trade on around about 50 times earnings this year, compared to a TSMC on more like 30 times earnings. So it's not as expensive as some of the other stocks that are exposed to the same theme. I think Jensen Huang, the CEO of Nvidia, said that Nvidia would not be possible without TSMC. So it is absolutely crucial for to enable this AI demand. They are the sort of the manufacturing foundry for these GPUs, and so Nvidia wouldn't be able to exist without TSMC. And actually, I think in the long run, you could argue that the sort of competitive advantage that TSMC enjoys are sort of more durable than Nvidia, and I think over the long run, TSMC will face sort of less competition even than Nvidia. So I think the outlook remains fantastic, but as you said, it's becoming an increasing part of the benchmark, and it's not possible to have an overweight position as an active manager. So what we've done there is to sort of broaden our exposure in semiconductors. And so there's obviously a whole supply chain around semiconductor demand, and we've added a number of new positions over the last year or so. A couple of examples in Taiwan would be a company called Elite Materials, which makes CCL, copper clad laminate, that is the building block for printed circuit boards that go into servers. So they have a dominant position in that category, and again, the sort of the main demand driver for them is server demand from AI. Another company would be Gudeng Precision, which is a company that make carriers that carry EUV masks that are used in the semiconductor process. And so there's a number of other stocks in Taiwan that also benefit from what we're seeing in terms of demand for AI and semiconductors. And so it's not just TSMC that benefits, but a number of smaller companies. And that's one of the great things about the investment trust, is we do have the ability to invest further down the market cap spectrum. We have a big analyst team at Fidelity looking for ideas in small and mid cap space, and that's where some of the sort of more exciting opportunities lie today.
Sticking with TSMC, and I suppose this also applies to those other names you mentioned. Before we recorded, we were talking about the kind of constant threat of, geopolitical unknowns if you're an EM investor. Are you concerned about, China kind of taking action on the Taiwan front, and how would that kind of affect things in terms of those exposures and holdings?
Yeah, it's something that we're constantly assessing and well aware of the situation. And one of the things that we do is commission a lot of experts to consult on the geopolitical risks, and so that's something the team is constantly doing. And so a big part of the process is understanding those geopolitical risks, and that will form our views on any stock. We'll look at all the sort of different scenarios that we think are possible and how that would impact each business in the supply chain. So yeah, it is something that we're well aware of, and it's a big part of the research process is sort of assessing how that geopolitical risk would impact each individual company.
Makes sense. So sticking with another kind of prominent name, big holding for the fund is Nasper's, the kind of Tencent owner. Why would you see that as kind of a better play than directly holding Tencent itself? What's the rationale?
So yeah, I think we've seen a big change in the way that Naspers operates over the past couple of years, and so generally, I think if you're positive on an underlying business, the best way to get exposure to that business is in the underlying company rather than a holding vehicle like Naspers. I think this situation is a little bit different because Naspers for many years was investing capital outside of their core holding in Tencent and various other industries. Yeah, food delivery being a big one, payments, e-commerce, and by and large, these investments proved to be unsuccessful. I think that they've acknowledged that today, and instead of deploying capital into new industries, they've instead started returning it to shareholders. So they've gradually started to sell down their stake in Tencent, and they're using those proceeds to buy back stock in the in Naspers and process. And why is that so value accretive? It's because the Naspers is trading at around about a 50% discount to the value of its holdings. So if it's trading at a 50% discount, it's selling those holdings and using that to buy stock. It's incredibly sort of value accretive for Naspers shareholders, and I think that's something that they'll continue in the future. And so I think at this point in time, it is very attractive to own Tencent via the Naspers stock.
We did see, I think that the CEO left quite abruptly last year. Do you feel kind of reassured about how things have shaped up now?
Yes, so there was an interim CEO that came in place for a period of time. He was expected to be the eventual successor. That turned out not to be the case. So we haven't actually met with the new CEO of the business yet. From all of what we've heard, the messages that we're still getting from the company is it's no change in strategy. They will continue to focus on returning capital to shareholders, and we'll be looking to meet the incoming CEO as soon as possible.
Is that something, I mean, at the minute, you can't really speak to a kind of UK equity manager without discussing buybacks because it's such an enormous part of that market. I mean, is that also like a broader trend we're seeing in EM, or how widespread is it?
Absolutely, particularly in China. I think we've obviously seen growth slow down in China in recent years. A lot of that means a lot of the corporates are also seeing their sort of rates of growth slow down. And as companies grow less, returns to shareholders become a more important portion of that sort of total shareholder return calculation. And so it's very important when a company does see its growth starting to slow down that they do sort of start to return capital to shareholders. And that's absolutely what we're seeing in China, particularly amongst a lot of the large cap names, the Alibabas, VIP Shop, AIA, the insurance business. All of these companies have increased their sort of buyback programs, and so not only are they paying dividends, but also buying back stock. And if you were to look across a number of the sort of blue chip Hong Kong listed shares, there are many names that have got buyback programs that are between an 8 and 15% of sort of shares outstanding, and so it's a very material amount of buybacks that we're seeing today. And I think that's something that's being encouraged by the Chinese government as well.
So, yeah, it'd be useful to turn to your general take on China. That's been obviously, a huge dividing line between different emerging market managers, since we saw feels like an age ago now, but the regulatory crackdown a few years ago and so on. What interests me is you guys appear to be kind of underweight, I guess, direct Chinese shares, but have like a decent slug of exposure to Hong Kong. So I guess to start off, it'd be interesting if you could sort of talk me through that, and then we'll talk about the more general kind of outlook for the Chinese market.
Yep. So there are two ways to invest in China. It's the onshore A share market
Mm.
and the offshore. It's called the H share markets, the Hong Kong listed stocks. And so what we've seen over the last 3 years, I would say, is international investors exiting China en masse. And
Mm.
international investors typically own the H share stocks. They're much easier to access. And so that has forced the Hong Kong market to sort of unprecedented low valuation levels earlier in the year. So for that reason, we see many more opportunities today from a sort of valuation perspective in the Hong Kong listed names, because international investors have abandoned the space, and that has forced valuations much lower. Whereas the onshore market, the A shares, they're by and large held by domestic investors, and so you haven't seen the same level of selling pressure in the domestic names.
I mean, I guess it'd be interesting first to hear your kind of general take on China, and then I guess where do you see the most interesting opportunities, and then the kind of biggest risks? Because, like I said, it's such a divisive kind of market to be in or not be in right now.
Yeah, absolutely. Yeah, and I think it's incredibly important to be very very active with your sort of China exposure, because there are a number of sectors that are under a lot of pressure, and there are some sectors where I think the outlook remains positive. So if you sort of take a bit of a step back, what's happened in China over the last 5 years or so? As you mentioned, there was the regulatory crackdown, and a number of sectors in the tech space, the education space suffered as a result. The other thing that you saw was a very sort of a very sort of strong focus from the government on deleveraging the property sector. And so the levels of construction that we saw 5 years ago in China, north of 1 billion square meters of residential real estate being added every year, these were completely sort of unsustainable levels of construction activity, and extremely unhealthy. Around about two-thirds of properties being constructed were for investment demand rather than people living in the houses, and they were being left empty and held by investors. So it was a very unhealthy situation. And also, it meant that a lot of property developers had geared up their balance sheets enormously, Evergrande being the most famous of them, but
Mm.
there would be 50 or 60 developers that were sort of completely insolvent. And so the government wanted to fix that issue as well. And there was a number of policies put in place to ensure that. The most important being the three red line policy, which was restrictions around leverage for the property developers, that was introduced in 2020. And so we had 3 years since then of pain for the property sector, volumes declining, house prices declining. And so it's been a painful adjustment, but I think it was absolutely the right thing for the government to do. Fast forward to today, and you've seen a big policy pivot. I think the government has achieved what they wanted to do in terms of reducing the size of the sector. Depending on what measure you're using, the property sector has become about a third smaller over that time period. Much healthier today. A lot of developers have been forced into bankruptcy, and going forward, you'll see the market much more consolidated with some of the state developers who have very strong sort of financial positions, and so a much healthier starting point. But the market is still under pressure in terms of house prices, and that has had a huge impact on consumer demand. It represents somewhere between the housing market represents somewhere between a quarter and a third of GDP. So consumer spending and consumer confidence are very strongly linked to the housing cycle, and all of the policies that you're seeing this year, down payments requirements being lowered, the 5-year LPR rate, which is the mortgage rate in China, being lowered, banks being encouraged to lend to developers again, and lending to consumers. All of this, I think, the government is trying to put a floor in the housing market and trying to stabilize or reflate house prices. And I think once you see house prices stabilizing, which I think we're getting fairly close to, you can start to see a recovery in consumption. And so I think one of the areas in China that has suffered a lot over the recent years has been the retail sector, and the retail stocks. And I think once the housing market does stabilize, you'll see that excess savings that the Chinese consumer built up during COVID start to be spent, and people will start to spend money on apparel, on services again, and that will be an important driver for the Chinese retail stocks, consumer stocks. Where we're more concerned is around the industrial sector. You have enormous amounts of overcapacity that's been built up over the years in China. Again, it was sort of tied to the property sector. You've had huge sort of investment in capacity in steel, in cement, in chemicals, in EV factories, in solar, and all of these sectors face enormous oversupply. And so I think these sectors are by and large uninvestable for the foreseeable future. No, not only is it an issue in China, but China's exporting that excess capacity to the rest of the world. So to summarize, I think we're sort of approaching the lows for the consumer, and I think we can see a recovery in consumption in some of the consumer related stocks. But on the industrial side of things, we remain very cautious, and that's where we don't have exposure today in the long book, and the Fidelity Emerging Market Trust has the ability to short. So we try and make use of the short book here, and there are a number of shorting opportunities in that sort of industrial complex in China.
Yeah, the shorting ability is interesting, and it's the thing that I guess distinguishes this fund from some of the other kind of emerging market funds out there. To what extent are you using that shorting ability at the minute relative to kind of the recent history, and what other areas are you sort of deploying those short positions?
Yep. So the exposure of the short book is relatively stable over time. So today it's at around about 25% of the assets, and we'll have a number of different ideas. So for sort of risk management purposes, our positions in the short book would typically be a lot smaller, and so they're spread across a number of different countries, a number of different sectors. So yeah, the industrial sector in China would be an area where we have a lot of ideas today. Another would be in the globally in the petchem space. You've got an enormous amount of oversupply in petrochemicals, and yeah, we don't see that changing anytime soon. And so that would be another sector that I think is quite a good hunting ground for short ideas.
Yeah.
But we try and have a very diverse short book, and we'll have positions across every country and every sector.
Yeah. I mean, have you ever got particularly burnt by shorting? I mean, it's because it's obviously your risks can be very high if you get caught out and a stock soars, but
Yeah, so we're very cautious with position sizing. The average size of a short position that we have is around about 0.5%, and we'll have a limit of around 1%. So it's very difficult for one individual short to cause sort of too much pain for us, and we're constantly sort of monitoring all the sort of the technicals around how crowded the idea is, how the availability of borrow, where the borrow is coming from, that sort of thing. And so yeah, we're very cautious in that regard. I would say, particularly in a sort of time of higher interest rates, it's made it a lot easier for short selling. Often we'll be looking to short businesses where the balance sheet is broken, the companies have inappropriate levels of debt, and in the past, these sort of zombie businesses would easily be able to refinance that debt. There wouldn't be a big interest burden as a result. And today that's no longer the case. So a lot of these companies are having to take their medicine, and they're struggling to refinance a lot of the time. And that has meant that it's a fantastic environment for shorting. So over the last 12 months, the short book added about 5% to the fund performance on a relative basis. And so it's been one of the best periods for the short book that we've had.
you're finally seeing some of that creative destruction, I guess, that people talk about with higher rates. And
Yeah, and I think it's healthy for economies and in the long run to see these these legacy zombie companies having to restructure, and so I think it's a good thing.
so turning to one of the other kind of main markets, one of the very popular markets in recent years, India. You guys have been, I guess, roughly in line with the benchmark, and India is, sort of catching up with China almost now in terms of being one of the biggest countries. So Taiwan is also very prominent at the minute. What is your take on India again? It's interesting. It's kind of returned to market darling status in my eyes in recent years, and then you get the attendant worries about whether it's kind of a bit too throttily priced, that kind of thing. Yeah, what are your main concerns, but also what is exciting in India at the minute?
Yeah, so it's definitely one of the few markets in EM that has that is trading at a premium relative to history. So if you
Mm.
look at EM as an asset class, EM equities, we're at sort of very depressed levels of valuation. The two exceptions being Taiwan and India, and I think for good reasons. Taiwan, it's for some of the stuff that we've already mentioned around sort of the semiconductor supply chain. In India, it's because of the fantastic sort of long-term demographics that the country enjoys, and so to some extent, I think the valuation is justified. There are definitely areas of the market that we avoid. So I think, particularly in the consumer staples sector, there's a lot of businesses that aren't actually growing at particularly impressive rates, and so growing more and less in line with nominal GDP growth. And these are businesses that are trading at 50, 60, 70 times earnings. So those type of valuations will try and avoid. One area where we do see a lot of opportunity is in the banking space, and I think that financials is a sector in India that it benefits from all of those sort of demographic tailwinds that the consumer sector enjoys as well. An increase in sort of financial inclusion, people taking out insurance products for the first time, and so it is a sector that does benefit from those demographic tailwinds, but it doesn't have the premium valuation that you see in other sectors. So I think Indian banks is an area where we have a lot of exposure today, and I think the valuations are very reasonable, and there are some fantastic businesses in the sort of the private banking space.
HDFC, I guess that's is that still probably the best known bank in India? Is that still the most attractive name you kind of identify there? I see it's in your top 10. It used to, doesn't seem to be now, but it used to also be in the kind of, top 10 constituents of the benchmark too, like probably a reasonably familiar name for EM investors.
Yeah, I think it remains one of the highest quality banks in India. What I think you've seen in recent years is that some of the banks that in the past might have been considered slightly lower in terms of quality than HDFC, an Axis Bank, or an ICICI have narrowed that gap. And so you've seen some of the other banks sort of catch up in terms of their return on equity or the general quality of the franchise. And so I would say, and for that reason, we've sort of broadened out our exposure in the Indian banking space. So there are in the past when I think people would have said that HDFC and Kotak are the two standout quality banks in India. There are a number more to choose from today, and partly that's because of how strong the Indian economy has been, and you have a very sort of benign environment for asset quality. So asset quality is not an issue for the banking system as.
Mm. We've spoken a lot about China and India, and they are so prominent in the index. Um, do you kind of feel the need at all to sort of like diversify away from that, or does that seem like a roughly kind of justified thing? I mean, I guess it's a classic sort of concentration risk and skewed market risk, perhaps.
Yeah, yeah, I think it's a good question, and I think it's something that a lot of emerging market fund managers are grappling with today is that sort of increasing sort of country concentration. And I think if you take the countries individually, I think China is about 30% of the benchmark today, and I think ourselves and most other emerging market investors would be uncomfortable having that level of China exposure, particularly given the challenges that I mentioned that the some of the industrials face, and the banking sector in China is obviously is something I also worry about. A lot of that sort of that problem with the balance sheet of the developers has been transferred to the banking system, and so we're not keen on the banks either. And so there are big chunks of the Chinese equity market that we're not comfortable with, and so it does become difficult to have a benchmark weight in China. And so we have definitely diversified into a number of other countries. We're a bit more comfortable with India in particular because of some of the fantastic sort of long-term demographic trends that I mentioned, and Taiwan as well. Yeah, you have some fantastic businesses in the technology space in Taiwan, and so those two countries were a bit more comfortable, and their benchmark weights are both today below 20%, so not quite as extreme as what we see in China.
And it might be a bit of a crystal ball question, but are there any, I guess, kind of lesser known emerging markets or any countries that you would envision becoming a greater part of the fund in the coming years beyond those big names we discussed?
Yeah, absolutely. I think Vietnam is a country which is by MSCI classifications, it's frontier
Frontier,
today.
yeah,
Yeah, but I
yeah.
think in the coming years that will change. Eventually, it will be promoted to emerging markets, and so yeah, when you have visibility on a country being upgraded like that, we're happy to take exposure today, and so we have a number of investments in the trust in Vietnam. It's yeah, a fantastically growing, rapidly growing economy. You have a highly skilled, low cost labor base, and so it's one of the biggest beneficiaries from the sort of, I guess, as a result of geopolitical tensions and general sort of cost inflation in China manufacturing.
Mm.
Lots of companies are looking to diversify their supply chain, and Vietnam will be one of the main beneficiaries there. Yeah, and it is a very so they've got a great education system. It's a very highly skilled workforce. One of the companies that we're invested in the trust is a company called FPT, which is an IT services business, which is a sector globally that's struggled for various reasons. But FPT has continued to thrive given a fantastic sort of value proposition they offer their customers with that sort of low cost, high skill labor force that they enjoy in Vietnam. So Vietnam would be one area. I think another country that is often overlooked by emerging markets, but is a big part of the index today is Saudi Arabia. And again, they have yeah, some fantastic demographic tailwinds, women entering the workforce, a very young population, huge investments in their sort of non-oil economy, and so a number of long-term positives that the country will enjoy. And it's an area that I think is a bit overlooked by emerging market fund managers. It is an expensive market, and so you have to be sort of very selective and yeah, it really helps to get out to the country and meet the management teams because they've not been in the MSCI EM index for a long time, and so the management teams typically don't travel that frequently to meet investors. So you actually have to get out there to meet with these companies, and yeah, that's a big part of the process. And we spend a lot of time in Saudi Arabia at the moment looking for ideas.
And are there any? I mean, with EM, a big part of the case for it is often about the kind of demographics that you mentioned. Are there any kind of overlooked themes in your mind in the region that people don't really consider when they think about investing there?
Yeah, I think one of the most important themes globally, and it's a little bit tied to AI and semiconductor demand, is the backdrop for commodities,
Mm.
and specifically for copper. And so, yeah, most copper mines sit in emerging market countries in Latin America and in Africa. That is where most of the world's copper is produced. So it's an incredibly important driver for a lot of EM economies, and it's an area where I think you've had a decade of underinvestment in copper, and so there have been no new greenfield discoveries of notable size in copper in the last 10 years, and it takes about 10 to 12 years to bring a greenfield discovery into production. So you can have
Mm.
very high visibility that for the next decade, there's going to be very little growth for copper on the supply side. And on the demand side, you have not just the sort of copper that goes into data centers for sort of AI demand, but also the electrification of the automotive fleet and the infrastructure around that. And we think these two drivers can add about 5 to 6 million tons to copper demand out until the end of the decade. And that compares to a market size of around about 26 million tons. And so it's an enormous driver for demand growth. So you have this situation where fantastic outlook for demand, absolutely no new supply coming online. And so I think that means we see higher copper prices for many years to come. And there's a number of not just copper miners that benefit from that, but also countries like Chile and Peru that are big exporters of copper. And so it'll be a big boost for these economies as well.
And I guess finally, on the other side of the coin, are there any major risks, or what risks do you think are being overlooked by investors or kind of not properly priced in?
Yeah, so I think China would be one of the most obvious ones for emerging markets, and
Mm.
it's going back to some of the points that I mentioned earlier around overcapacity, and so solar is probably the best example here, where you do have a great demand backdrop for solar as well, but it has not kept pace with what we're seeing on the supply side from China. Polysilicon is probably the most oversupplied bit of the value chain in solar today. Last year, capacity in China grew by 100%. This year, it will be in the region of 40 to 50%. So you had a huge amount of supply being added into solar, and you've seen prices collapse, and that is true for a number of different industries. So I would say the first area of concern would be around, sectors where China has added a lot of capacity and they're exporting that excess capacity to the rest of the world. And so it creates problems for not just China, but other producers of these commodities. The next area would be around trade tariffs. And so I think you're seeing a bit of tension in the automotive space today, with the between the EU and China. And China has obviously been enormously successful in producing electric vehicles at much lower costs than some of the incumbent legacy OEMs in Europe. And so you're going to see, I think, China localize production. So BYD, for example, building factories in Hungary and Brazil and Thailand, and they're going to take a lot of market share in these markets. And so you're seeing a lot of tension. Today it's between the EU and China in the automotive space, but I think that will spread to different industries. And who knows what the outcome will be of the US election. But I think it's widely acknowledged that Trump is more likely to increase tariffs than decrease them. And so I think companies in China that rely heavily on the export market and selling their products into the US are at risk from trade tariffs increasing in the future.
Yeah, so more moving parts to keep track of, I think. Well, it's very interesting stuff, but I'm afraid that is all we have time for. So I'd just like to thank Chris for coming on. Thanks to our fantastic producer, Maddie Apthorpe, and thanks to you for listening. Take care.